Hello guys, welcome to Brother Dog's Finance channel. In this introductory session, we'll briefly go through our macro investment tool, the MRI, and the micro investment tool FSS with you guys. MRI stands for Macro Regime Identification. It tells investors what cycle the stock market is in based on the relationship between a couple of moving average lines of the broad market ETFs. While FSS, the factor scoring system, is a micro-level stock selection tool. It checks the firms from multiple angles, including its relative valuation, business quality, growth potential, price momentum, and the daily return volatility, to come up with an overall recommendation score for investors, aiming to help filter out those companies that can deliver better than broad market returns during the long term and through different economic cycles. Let's firstly take a look at the macro tool, the MRI, and here we use Nasdaq 100 ETF, QQQ, as an example, because it is one of the most popular broad market ETF being traded across the world. In the chart, we plotted the short-term and long-term moving average lines of the ETF first. In our case, we just choose the short term as 10 days while the long term as 200 days. However, the numbers here don't really matter as far as one is short term and another one is long term. That is all good. Then, based on the long term moving average and the long term market volatility, we further plot three bound lines where two are above the long term moving average. We call the higher green line as upper bound, which is long-term moving average plus 2 standard deviation, and the lower yellow one as stable bound, which is long-term moving average plus 0.2 standard deviation. And another black line below it, we name it as lower bound, and it sits 1 standard deviation below the long-term moving average. Once we have these three lines, we automatically cut the market into 4 areas, which from the top to bottom correspond to overheat, expansion, struggle, and collapse market regime. Lastly, we will just define the current market phase based on where the short-term moving average falls under. For example, here, at the end of July 2023, the end of last month, the market is basically in an overheat mode. And digging into the main characteristics of the 4 regimes. The regime 1 overheat. This is when market goes up rapidly in a very short time period, and in general, this is a sign of market overshoot. Ideally, you want to take some profit here. Regime 2, the expansion. This is when the market is in a healthy uptrend. Market goes up in a benign mode, and market volatility tends to be the lowest under this regime. So you can consider to add on the risks, like adding positions or even taking some small leverages. Regime 3 is the struggle phase. Market gets tricky here and the trend tells you that the market is going down. However, it's still too early to tell if the market is really going into a downturn or not. So under this regime, it's better to stay conservative and decrease the leverage if possible. The lastly is the regime 4, the collapse. This is a truly risk-off scenario. Market goes down quickly in the short term, and what's hurting more is the market volatility. Market shows the biggest daily volatility under this period, while it is recommended to just keep risks off and even consider to stop loss. And that is the MRI framework. We used the QQQ here, but please keep in mind that the framework can be applied to any broad market ETFs, such as the SP500 ETF, SPY, or the Dow 30, Dow Jones Industrial Average ETF, DIA, and etc. Then the next framework is a micro stock selection model, FSS, the factor scoring system. The system measures attractiveness of a stock, scaling from 1 to 100, while higher score stands for more attractiveness and better potential future returns. How the system works is it looks at different angles of the company and assigns a score for each, which later will be aggregated to the overall score. These angles, while we call them big factors, currently include the relative valuation, business quality, growth potential, market momentum, and the stock price volatility, where each of these big factors is aggregated from multiple subfactors. For example, the relative valuation measures how the stock valuation ratios, such as PE, PB, P, free cash flow, look like, compared to other companies. The business quality sees how robust the firm's financial status is by checking its margins, return on equity, asset turnover, and etc. For growth potential, it measures if the company is growing the revenue and net income, etc., at a stable pace or not. Theoretically, as our investors, you want to put your money into those business models with benign and consistent growth potentials, while market momentum and stock volatility factors are market-driven indicators, and they are used to see how the stock is doing on the market during the recent time period. To summarize, with all these factors, our final goal here is to rank stocks under the different universe, so it can help us to filter out names with healthy, strong financial conditions and positive market sentiments. Here we do provide and update the model results on 4 major US indices: the SP 500, the Nasdaq 100, Russell 1000, and Russell 2000 on almost daily basis via the Google spreadsheet with link below our video, and welcome all of you guys to check it out and give any of the suggestions and recommendations. For more details, such as how we came up with the 2 models and how to exactly use them for the investment purpose, we will cover them in our other videos. If you like me, please subscribe and stay tuned. And let's go get rich.